The the part that I want to clarify also, David, is the inventory accounting. Yes, when you are setting your pricing, you want to look at the fully loaded cost. But that's not what I'm referring to. You know what I'm referring to is this. Let's say that you sold 1,000 pieces. And let's say that you have done everything to take that settlement report and bring it down to the line item level and grouped it, and you saw all the buckets, advertising, blah, blah, and the everything else. You're looking at as percentage. What is missing in that picture? It's cost of the inventory that was sold. That's associated with that settlement report. How do you know that? A lot of the sellers don't know. What they do is they buy merchandise, they pay the bill, they post it as a cost, and it sits on the books as an expense. And then, as the sales come in, you see where I'm going with it. That's the challenge.
I do, yeah. And so what you're getting at is accrual-based accounting versus cash-basis accounting. And I'll make this pretty quick. I don't want to put people to sleep, but in the instance where you buy it, that shows up as an expense in 1 month, that would be cash-basis accounting. And I find that to be not very helpful. Accrual basis would be when you buy the inventory, it goes on your balance sheet as an asset. And as you sell off that inventory, it gets flushed out of the balance sheet through your income statement by the number of units sold multiplied by your unit cost. And so that would be something when you're talking to a bookkeeper, I want bank reconciled financial statements on an accrual basis, and that would be what you're returned with. And so, yeah, does that answer your question?
Yeah, it does, except that I'm gonna dumb it down.
Okay.
Because as soon as you start using these fancy terms like accrual basis, people don't really, I mean, everybody understands cash basis, but basically the idea is very simple. If you spend $1,000 on merchandise and you put it on the shelf in the warehouse, that's an asset. It's not a cost of, it doesn't matter, forget the accounting basis or systems or anything. Just from logic standpoint, that's an asset. It's like you bought a car. It's not an expense. So that's an asset. So the way you must structure your accounting is, there are two ways to do this. It's very simple. You just have to start with the right one. Set it up in a way that will simply, when you make inventory purchases, it will post it as an asset. And then when you issue an invoice, which is what you will do for a settlement period, then it will deduct the cost of the inventory from the asset and then transfer it to the cost of the goods sold. So that way you will be reducing your asset value and increasing your cost. And then when you pull your P&L from your QuickBooks or Xero or whatever, or your Google Sheets or whatever you are using, you will know that lump sum that sits in cost of goods sold account is the right one, because it will be done automatically. And then you can take that number and say, okay, I'm going to plug that into the full picture, and that's your net deposit, or I should say net income. Then you've got a healthy starting point. Would that be right?
That's exactly right. That's exactly right. And I think you explained that in a very good way. Yep.
Yeah. Okay, cool. Okay, because this is, you know why I care about this? I made this mistake myself, and I love numbers because it was my early days. I had no idea, and I would get orders, and it was a mess.